A. Identify the users of these financial statements and their needs. External users focus on resource allocation and risk assessment. Investors use financial statements to evaluate profitability, growth prospects, and return on investment to decide whether to buy, hold, or sell shares. Creditors assess liquidity, solvency, and cash flow adequacy to determine lending terms and credit risk. Analysts and financial advisors rely on comparability and consistency across periods to forecast performance. Regulators and stock exchanges examine compliance with GAAP and disclosure quality to protect market integrity and ensure transparent reporting. Internal users rely on statements for oversight and strategic evaluation. Management uses financial statements to evaluate operational efficiency, profitability trends, and capital structure decisions. The board of directors assesses stewardship and governance effectiveness. Employees may evaluate job security and compensation sustainability. Although management accounting provides detailed internal reports, general-purpose financial statements remain essential for aligning internal performance evaluation with externally reported financial outcomes under the accrual basis and going concern assumption. B. Demonstrate an understanding of the purposes and uses of each statement. The balance sheet reports financial position at a point in time. It presents assets, liabilities, and equity to help users assess liquidity, solvency, capital structure, and financial flexibility. By analyzing current versus non-current classifications, stakeholders evaluate short-term obligations and long-term sustainability. The accounting equation, assets equals liabilities plus equity, reflects the entity's resource structure and funding sources. This statement is especially useful in credit analysis, capital management decisions, and understanding risk exposure. The income statement measures operating performance over a period. It reports revenues, gains, expenses, and losses to determine net income. Users analyze gross profit, operating income, and net income to evaluate profitability and management effectiveness. The statement supports forecasting future earnings and assessing return on assets and equity. However, because it uses accrual accounting, it must be interpreted alongside the statement of cash flows to understand the timing of cash generation and earnings quality. The statement of changes in equity explains ownership and retained earnings movements. It reconciles beginning and ending balances of equity components, including common stock, additional paid-in capital, retained earnings, treasury stock, and accumulated other comprehensive income. It distinguishes between performance-based changes, net income, and owner-related changes, dividends and stock issuances. This statement is critical for understanding dividend policy, capital structure adjustments, and cumulative comprehensive income effects. The statement of cash flows explains changes in cash and liquidity. It classifies cash flows into operating, investing, and financing activities. The operating section, often prepared using the indirect method, reconciles net income to cash flow. Investing activities show long-term asset acquisitions and disposals, while financing activities reflect debt and equity transactions. This statement helps assess liquidity, solvency, and financial flexibility by focusing strictly on actual cash inflows and outflows. C. Identify the major components and classifications of each statement. Balance sheet components include assets, liabilities, and equity. Assets are classified as current, cash, receivables, inventory, prepaid expenses, or non-current, investments, property, plant and equipment, intangible assets. Liabilities are divided into current, accounts payable, accrued expenses, current debt, and non-current, bonds payable, lease liabilities, deferred taxes. Equity includes common stock, preferred stock, additional paid-in capital, retained earnings, treasury stock, and accumulated other comprehensive income. Income statement components include revenues, expenses, gains, and losses. Revenues arise from primary operations, while gains result from peripheral activities. Expenses reflect resource consumption related to operations, and losses arise from non-operating events. Cost of goods sold is matched with sales revenue to determine gross profit. Multiple step formats separate operating from non-operating items. Discontinued operations are reported separately, net of tax, between income from continuing operations and net income. Statement of changes in equity includes reconciliation elements. It reports net income or loss, dividends, stock issuances, treasury stock transactions, other comprehensive income, and prior period adjustments. Retained earnings changes are shown separately. The statement ensures transparency in tracking equity movements that are not visible solely through the income statement or balance sheet. Statement of cash flows classifications include operating, investing, and financing activities. Operating activities relate to revenue-generating operations. Investing activities include acquisition and disposal of long-term assets and investments. Financing activities include issuing stock, borrowing, repaying debt, paying dividends, and repurchasing shares. Non-cash investing and financing activities are disclosed in notes rather than in the main statement. D. Identify the limitations of each financial statement. Balance sheet limitations stem from measurement and timing issues. It presents financial position at a single point in time, which may not reflect ongoing fluctuations. Many assets are reported at historical cost rather than fair value, potentially understating economic worth. Estimates and judgments affect valuations, e.g., depreciation, allowances. Intangible items like brand reputation or internally developed intellectual capital may not be recognized despite significant economic value. Income statement limitations relate to accrual accounting and exclusions. Revenues and expenses are recognized when earned or incurred, not when cash is received or paid. Thus, net income does not equal cash flow. Certain items bypass net income and are reported in other comprehensive income. The statement relies heavily on estimates such as bad debt expense and useful life assumptions, which may affect comparability and earnings quality. Statement of changes in equity has informational constraints. Although it shows equity movements, it does not indicate the availability of cash for dividends or debt repayment. Equity balances can fluctuate due to market-related comprehensive income items unrelated to core operations. The statement also reflects period-based changes and may not capture significant transactions occurring shortly after the reporting date. Statement of cash flows limitations focus on scope and classification. It excludes non-cash investing and financing activities from the main body, requiring note disclosures for completeness. Classification differences, e.g., interest treatment, may reduce comparability. While it explains liquidity, it does not measure profitability or long-term value creation. Additionally, it still depends indirectly on accrual-based net income when using the indirect method.